You spend decades building a California business. When it's finally time to sell, owners often multiply their top-line revenue by an industry average and expect to walk away with that exact figure. The gross valuation figure frequently functions as a vanity metric, obscuring the actual cash that arrives in your bank account on closing day. Buyers actively search for reasons to discount that initial number. If the business relies on your daily involvement to function, they will apply a severe owner dependency penalty to their offer. Then comes the state-specific reality. California taxes capital gains as ordinary income at rates up to 13.3%. Combined with federal taxes, the impact on your proceeds is significant. This waterfall chart illustrates a business sale. After operational discounts and combined taxes exceeding 30%, your net proceeds become a fraction of the valuation. Rushing this process signals desperation, giving buyers leverage to maximize discounts. Securing a high top-line multiple is irrelevant if you haven't engineered the company's operations and deal structure to protect your final payout. Buyers will attempt to dismantle an asking price built on a single formula. To establish a firm price floor, you must use 3 distinct valuation methods. First is the income approach. This method applies multiples to your EBITDA to evaluate the company's raw cash flow generation. EBITDA stands for earnings before interest, taxes, depreciation, and amortization, which is a standard measure of a company's overall financial performance. The vulnerability here is that the income approach is less effective if your historical earnings are erratic, or if business expenses are heavily mingled with your personal spending. Next is the market approach, which grounds your asking price in reality by comparing your business to recent sales of similar companies. The limitation of the market approach is data availability. Finding reliable public transaction records for private middle-market companies is notoriously difficult. Finally, there is the asset-based approach. This calculates a hard baseline value based purely on your tangible holdings, like manufacturing equipment and real estate. This method is largely ineffective for service-based businesses, as it misses the value of intellectual property and client goodwill. This Venn diagram maps the income, market, and asset approaches. When you execute all 3 methods independently, they create a tight, overlapping range of value that buyers cannot easily dismiss. A triangulated valuation shifts the negotiation power away from a buyer's subjective doubts and directly toward your objective data. Preparation dictates the final price. Specific preparatory actions, known as operational multipliers, can increase your baseline valuation multiple by 1 to 2 full points. This quadrant chart maps pre-sale tasks by their implementation effort versus their impact on valuation. The highest return on investment comes from normalizing 3 years of financial statements to show true profit potential. Formally adding back owner salaries and personal expenses requires meticulous CPA auditing to survive buyer scrutiny. Reducing any single client's revenue share below 30% eliminates a massive buyer red flag. The trade-off is time. This requires aggressive investment in new sales channels at least 18 months before you list the company. The most difficult yet most valuable action is removing yourself from daily operations. Documenting standard operating procedures and delegating daily decisions proves to buyers that the business will continue to generate profit after the ownership transition. Buyers pay premium prices for turnkey operations. High owner dependency is the most direct way to trigger a severe valuation discount. The final major hurdle is successfully navigating California's complex regulatory and tax environment during the actual transaction phase. Every California seller faces a core structural dilemma long before closing, choosing between an asset sale and a stock sale. This decision tree maps the deal structure. Buyers heavily prefer an asset sale because it allows them to step up the tax basis of the acquired assets, creating immediate depreciation benefits. But for the seller, particularly in a C corporation, this can trigger severe tax liabilities. A stock sale often provides cleaner capital gains tax treatment for the seller. The primary trade-off here is that buyers will aggressively lower their purchase price because they are inheriting the company's historical liabilities. Further complicating asset sales is the California Bulk Sale Act. This law exists to legally protect creditors when business assets are transferred. Complying with this act injects an inescapable 30 to 60 days of administrative delays and public notifications into your escrow timeline. Choosing the wrong deal structure can erase years of operational preparation. Early CPA tax modeling is far more financially impactful than haggling over the gross asking price. Executing a defensible exit requires a strict 24-month runway. Your priorities during this countdown are dictated by your specific type of business. If you own an asset-heavy manufacturing company, you must index heavily on the asset-based valuation approach to prove your baseline worth. Your specific operational trade-off is equipment condition. You must proactively fix deferred maintenance, or buyers will deduct those upcoming capital expenditures dollar for dollar from their offer. Service and technology business owners must rely primarily on the income approach, demonstrating flawless operational metrics to justify their asking price. Your specific operational focus must be locking in recurring revenue contracts and neutralizing client concentration risks. This 24-month Gantt chart outlines the exit timeline. Phase 1 fixes concentration risks and delegates operating procedures. In Phase 2, you execute financial normalization and tax modeling. Phase 3 triangulates your valuation range and goes to market with compliance ready. Engaging specialized M&A advisors early ensures flawless compliance, locking everything into place, and prevents your deal from collapsing during the aggressive due diligence process. Achieving your financial goals depends on moving past theoretical valuation multiples to a structurally optimized exit that protects your net proceeds.